lot of people would not prefer it when it comes to trading. Why do you think, first of all, I'm sure a lot of viewers are confused, what exactly are floating bonds and why is it not necessarily a preferred form of trading?
And when you're looking at this perspective, is most of the bulk of the bonds which are issued by government.
Right.
I would imagine if you're a government, you want a bit of certainty about the kind of rate you're going to pay in the future. So obviously if it's floating or maybe inflation linked, the actual obligation that you end up paying starts fluctuating, and that can also potentially create problems of its own. It's worth exploring, but that can also have other implications. We know, for example, locally, we know companies which took debt and they were pricing off, for example, Libor, now it's SOFR, and of course this benchmark rate adjusts over time, which now means if this benchmark rate adjusts, on this other side you end up paying a higher interest rate. And so obviously it's up to the central bank to look and decide whether this is the best possible way of doing issuances. They're usually also very clever in the way they issue their debt instruments. They don't want to lock themselves for a long time with very expensive debt. So when interest rates rise, what they do, they start issuing short-term instruments so that, if interest rates turn, that's when they start issuing like 20 years or 25-year instruments. So the central bank also has a treasury mandate in trying to minimize the overall cost to the economy. I'm sure they would have considered that. And maybe they would, if it makes sense, I'm sure they would consider it.
Nganga, Erica said something very ominous. He said there are consequences. What are your views on this topic?
On the topic of floating bonds?
Yes.
I hold the same position as he does. You'll find that one of the biggest problems that you might have with something that's not fixed is, one, it makes even your cash flow planning a little bit more difficult. If it's inflation linked, if inflation is going up, then it means the incremental costs that are being paid out actually higher. But on the investor side, if you're invested in something that's actually inflation linked or inflation protected, it actually helps because it means that this rate will increase your returns based on how well the economy is doing or how badly it's doing, how the inflation rates are going up, or whatever benchmark has actually been utilized. So it gets more expensive for the government from the public finance management side of things. On the investor side of things, then that kind of an increase actually creates higher returns for you. The downside of it is, on the flip side, is that if it's getting cheaper for the government, if the rates are going back down, it also means that the returns that for you as an investor might have been receiving will also be declining in the same direction. So it is a very interesting, let me say, it's a very interesting instrument in its issuance. It needs a lot of kind of figuring out. So if you expect that the interest rates are going to keep going down, so as an issuer, it does make sense. If you're linking it to inflation and you can see that you're actually taking certain actions towards reducing inflation, it does make sense to issue something that will get progressively cheaper. But as you mentioned, then what happens is that if it's going up, the government will choose then not to take very long-term paper and just decide that we're going to lock in this 18% for the next 364 days or for a maximum of up to 5 years, let's say, in this case. And then as it gets cheaper now, they'll be able to issue longer-term paper. So the same thing, I think, would be what might actually be influencing them when it comes to the issuance of these floating rate bonds. Are we likely to see the rates actually decrease and so it gets cheaper over time for the issuer? Or are we likely to see the rates increase, which then I guess is usually a lot of what you might call looking into the magic box and trying to see which direction will the country go. Will there be another pandemic? Or, so trying to do these predictions and making these choices. But as he said, the guys who actually are responsible, the teams that are responsible for putting these things together will typically have done a lot of this research before they make their decisions to do so.
Right. With all these fluctuations, as you said, you're looking into a magic box. You're supposed to predict a lot of things, gentlemen. I'm sure a lot of businesses are right now thinking they're not really thinking of listing. And that's a major problem for the Nairobi Securities Exchange and the involvement of locals in this particular, aspect. When it comes to listing of normal businesses, Eric, what would you say are one of, or rather the main factors that holds them back from listing?
Obviously, there's elements around the corporate governance that comes with listing. There's usually long procedures. You, as a founder of a businesses, most businesses in Kenya are family businesses, they have to let go of the ownership, because now once you bring in other shareholders, the other shareholders want transparency, they want the entire pie. If it's being split, it's split from, in a transparent way. And obviously that's a challenge. But I think also historically, as market players, we probably focused on bigger companies.